In this chapter, we will learn both money market and capital market securities as well as derivative securities. You are expected to understand the important features of various financial securities available for investors to trade on the market. Non-marketable financial assets such as deposits in savings accounts and CDs are commonly owned by individuals. Although not tradable, these assets are very liquid and it's easy to convert to cash without a loss of values. Money market securities have maturity less than 1 year. These securities are tradable, relatively safe, and highly liquid. Low returns are expected for money market securities. Examples are T-bills, CDs, federal funds, and so on. Capital market securities have maturity greater than 1 year. They are riskier than money market securities. Two basic types of capital market securities are bonds and stocks. A bond, also called a fixed income security, have a specific payment schedule with dates and amount of interest and the principal payments known in advance. Bonds are long-term debt securities. Buyers of newly issued coupon bond lends money to issuers. Issuers agree to pay interest and repay principal on maturity date. Bonds are fixed income securities because both coupons and principal payments in bond are fixed in advance. Bonds are considered to be safer than stocks or derivatives. Bond prices are quoted as percentage of its par value. Bond prices are mainly determined by the interest rate. At the maturity date, bond price will be equal to its face value. To buy a bond on secondary market, buyers must pay the price of bond plus accrued interest. Premium bonds are bonds priced higher than its face value, and discount bonds are bonds priced lower than its face value. Interest rates and the bond price move inversely. Callable bonds give the issuer the right to buy back the bonds from investors when the interest rate declines to a certain level. Many corporate bonds are callable. There are four major types of bonds in U.S. depending on who is the issuer: Treasury securities, government agency debt, municipal bonds, and corporate bonds. Corporate bonds are issued by some large U.S. corporations. It is risky for investors to invest in a corporate bond because in case of bankruptcy or liquidation, bondholders may not be able to get full payments of coupons and principals. Many corporate bonds are unsecured and callable. Convertible bonds may be exchanged for a certain amount of stocks at a bondholder's discretion. Floating rate bonds are inflation protected bonds issued by some corporations. The amount of default risk in a corporate bond can be assessed based on its credit rating. Both Moody's and S&P offer bond rating services to investors. Higher the credit rating, higher the quality of the bond, but the lower the default risk. Credit rating has inverse relation with bond investment returns. A bond rated AAA, AA single A, or triple B is so-called investment graded bonds. A bond rated double B, single B, double C, and triple C is a speculative bond with significant default risk. Junk bonds are rated lower than double B. Junk bonds are also called high yield bond. Securitization is a process where illiquid and risky assets be transformed into more liquid and less risky marketable securities. Asset-backed securities, or ABS, is a securitized interest in a pool of non-mortgage assets such as auto loans, credit card receivables, small business loans, or leases. Equity securities represent an ownership interest in a corporation. Shareholders of a firm have both voting rights and residual cash flow claims with limited liabilities. Preferred stock is a hybrid security that has a feature of both debt and equity. Preferred stockholders do not have voting rights. They receive fixed amount of dividends from the company each year. Common stockholders are residual claimants on a company's income and assets. Par value is the face value of a share. Book value is accounting value of a share. The market value is the current market price of a share. Aggregate market value is the market price per share times number of shares outstanding. Dividends are often paid to shareholders as at the discretion of management. Greater uncertainty in future dividend payments makes common stock risky securities. Dividend yield equals dividend divided by stock price. Dividend payout ratio is a percentage of earnings that are paid out as dividend. Stock split is the issuance of additional shares in proportion to the shares outstanding. P/E ratio is the ratio of stock price to its earnings per share. It shows how much the market is willing to pay for $1 of earnings that will be generated in the firm each and every year. International investing has potential to provide investors with higher returns and a lower risk. Currency risk is a very important concern for investors who invest globally. U.S. investors can invest globally through ADRs with a greater convenience and a lower transaction costs. American deposit receipts, or ADRs, representing direct ownership of share of a foreign firm. Futures options are typical derivative securities. Derivative securities prices are derived from other financial assets, such as stocks, bonds, and commodities. Derivatives are great tool for risk management. Future contracts and obligations to buy or sell. Option contract is the right to do so, not an obligation. Of course, we'll learn a great deal of both futures and options later in the future. Okay, this is pretty much for today's lecture. I hope you enjoyed the video, and I'll see you in the next class. Thank you. Bye-bye.